As inflation comes down, hopefully some of those prices will revert and they'll come down. Food prices often, can round trip, and energy prices too. But gas prices are high, and that's always, a negative thing for consumer confidence.
Going forward, if there are no significant changes in the data in the coming weeks, I expect 2 additional 50 basis point rate hikes in June and July.
Russia's war against Ukraine has exacerbated the issue of food security for people around the world, particularly in emerging and developing countries.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in New York today, and here's what's coming up on today's program. Market rout. U.S. stocks suffer their worst sell-off in almost 2 years as growth fears pummel sentiment. European stocks also slide at the open. Supply chain shock, a warning from Cisco, and inflation pain for retail hammer sentiment, and growth warnings abound. Well, JP Morgan is the latest bank to slash its forecast for the U.S. as Standard Chartered downgrades China. Now, a lot of the story, of course, is playing out on the market. So onto the markets, and after the S&P yesterday and that huge fall, one of the biggest and ugliest days we've had in the last couple of years, we look towards sentiment in Europe. Now, European stocks are also sliding again. It's really the concern about higher inflation cutting into corporate performance, overshadowing some of the bargain hunting of beaten down stocks that we saw in the last couple of days. European stock 600 down some 1.6%. Technology again getting slammed. And I guess it's the bets of these robust earnings that could have helped investors weather the turbulence, and that is now thrown into doubt after U.S. consumer titans signal growing impact of high inflation on margins, but also on consumer spending. Now, if we break down the European map to see exactly the countries that are doing better and the ones that are doing worse, quite a lot of red on the screen. There's not a huge difference whether you're sitting on the FTSE or whether you're sitting over in the DAX. Again, it's energy, it's inflation, but it's really markets trying to price in some kind of growth scare. The question of the day is, without a doubt, where's the bottom from the S&P 500? That's a question we'll be asking all of our guests. Now, European stocks sliding, pointing to more pain ahead following the biggest drop on Wall Street in nearly 2 years. Earnings report, as I was saying, from retail titans, Walmart, Target, increasing concern that some of this higher inflation will start biting when it comes to consumer spending.
We are playing it more conservatively than more aggressively, both on the fixed income as well as on the equity. So to your point, dialing down areas that are high yield or areas like that.
It's a different phase of investing. It takes different approaches. Your best approach is actually to de-risk portfolios, at least back to neutral to some degree.
I think today is a little bit more validation that the consumer is not as strong as we thought it was, that we're starting to see inflationary pressures really affect the earnings of companies.
The consumer is getting weaker from the bottom level up, so from the lowest income up, and it remains to be seen where that stops.
Let's get into the key market drivers with our markets live editor, Noor Ali. Noor, so great to see you. First of all, was it pretty naive to think that you could have inflation at 6, 7, 8%, and actually the consumer doesn't feel anything?
That's a little bit difficult, right? Because last year, Francine, you and I sat on this stage and we talked about how these costs will carry through to the consumer ultimately. And, we were all in contractual obligations. We were saying, no, it's okay for that year. But we knew it's going to extend, and we knew that it was going to hit these companies ultimately, so much so that they'll pass along these costs to the consumer. And that makes inflation a lot stickier because it's a lot harder to change prices now that we're still into this tightening cycle. We haven't even started yet, and these prices are starting to trickle down even more.
Nora, I'm looking at the sectors, and actually a lot of them are getting slammed, but it's really the consumer goods that I think are losing the most in Europe, around some 3% lower.
Yeah, absolutely. And even energy, you would assume that maybe energy could be a shelter this morning. It isn't. We're definitely struggling. We're in a very classic risk-off situation. You do see some havens. The bonds are doing very well. The Swiss franc, the Japanese yen, they're performing much better, but surprisingly not the dollar, because, a lot of the people are telling you now, perhaps we've topped out in the bottom, and now we've topped out in the dollar, and we're going to start seeing some struggle ahead for that.
So, Nora, we need to talk about the dollar. The dollar rally really hurts so many asset classes. Does it actually give us an indication of where money is pouring into, where it's rotating to?
Well, look, I mean, the very interesting thing what's happening in the dollar right now is that it's been the haven choice for the last year because everyone's been saying, okay, we're going to take cover now in the dollar. So you did see a lot of struggle, even bonds and other haven currencies like the Swiss franc and the Japanese yen were underperforming relative to it. This morning, all G10 effects are up against the dollar at a time where you would assume the dollar would pick up and carry through. That's because you've seen some decoupling across with yields. So if you see a correlational study with the dollar against two-year yields and the Treasury's front, you'll see that, that they've really parted ways there. So I'm anticipating some trouble ahead for the dollar.
Nor, with all of these great graphics, where have you been all my life? Nor is bringing like her A game in terms of like 2 standard deviations in some of these markets. What does it mean going forward, Nor? I mean, when do we know when we've hit bottom? How difficult is that to call?
So it's a little bit difficult because we still haven't started the tightening cycle officially with the Fed. We have raised rates, sure, but we're still a long way ahead. I think it's going to be a troubling summer. So I'm about to book my holidays now just to make sure that I'm here for a very busy summer. I think the bottom is still a ways ahead for sure.
Okay, you and we take the show to Amalfi, so that can be our holiday, but we're still on Stocks Watch. Our Bloomberg MLive editor. You like the sound of that, Nor? I'd say yes, right? Nor Ali. Now, let's also look at what Cisco shares are doing. So this is pre-trade, but actually they're falling some 14% in U.S. Pre-market trading. This is after they cut their forecast, and it's really very clear that Cisco spooked investors with a warning that Chinese lockdowns and other supply disruptions would wipe out sales growth in the current quarter. That's renewing broader concerns about tech spending in a pretty shaky economy, and that share price pre-market down 14%. Now, Treasury Secretary Janet Yellen has confirmed it's unlikely that the U.S. will extend an exemption that allowed Russia to make bond payments to U.S. investors. Speaking ahead of a gathering of G7 finance ministers, Yellen said the U.S. and its allies and partners share the goal of reducing Russia's revenues in the wake of its invasion of Ukraine.
The sanctions imposed against the Russian Federation have already had enormous impact. Russia's experiencing recession, high inflation, acute challenges in their financial system, and an inability to procure the material and products they need to support their war or their economy.
Now, for more, we're joined by Bloomberg Europe economy reporter Alessandra Migliaccio, who's at the G7 finance meeting in Bonn, Germany. Alessandra, good morning. So what exactly is on the G7 agenda?
Good morning, Francine. Good morning to everyone. There are many things on the agenda. Obviously, Russia, Ukraine is the main topic this morning. It's going to be the main topic for the beginning of the meetings here in Bonn. What to do, how to help Ukraine immediately, the practical aspects, and of course, sanctions. Are they working? How much they're working? You know, what to do next. There are other things, however, on the agenda. The meeting continues tomorrow. The world economy, of course, concerns about inflation, especially with the impact from the war in Ukraine, Russia's invasion, and what it's done to energy prices. Monetary policy is, again, an issue because, of course, here we don't have just the finance ministers, we have the central bankers, and monetary policies are different among countries. So all of that on the agenda, and very quickly, climate as well, and tax policy as well.
So will they reach an agreement for, to give Ukraine more aid?
Yes, they're relatively confident on that as immediate aid. I mean, everyone is pitching in. The U.S. just passed a package that's worth $40 billion. It's different things. Europe is pitching in. Each single country is giving aid. You have the EBRD. But what they're talking about today is immediate aid. Ukraine has estimated their finance ministry that they need about $5 billion a month. So they will try to give the initial $5 billion and then go on for another 3 months at least. So that should be about $15 billion. And then we'll see, obviously, what happens next.
Alessandra, thank you so much. Alessandra Migliaccio there in Bonn, Germany for us at the G7. Now, coming up, we'll have much more analysis of the latest market sell-off and what it means for central bank policy. We'll be joined by Salman Ahmed from Fidelity International. It's going to be a robust conversation on, of course, the sell-off and markets. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in New York. Now, risk-off sentiment continuing to spread through the market. Stocks cannot catch a break as earnings report from U.S. consumer titans like Walmart and Target stoke inflation concern. We also checked on Cisco pre-market down 14% after it cut its forecast. Now, we're joined to talk about the markets, to talk about the way forward by Salman Ahmed. He is Global Head of Macro and Strategic Asset Allocation at Fidelity International. Salman, as always, thank you so much for joining us. First of all, should we have expected this kind of consumer reaction? If inflation is so high, it's very unlikely that the U.S. consumer can stay strong.
Good morning, Francine. Certainly, I think the fact that inflation has been now strong for a while now, this is where the pressure is starting to build. I think there was this thesis that the excess saving buffer, which was built up as a result of the COVID fiscal packages, and the fact that people were not able to spend as much because of the lockdowns, will create some kind of protection against this high inflation. But the fact is that when you have inflation at 7-8%, the real purchasing power is falling quite sharply. And this is not a 1%, 2% inflation world. And that's where we are seeing the pressure come through on the consumer, given that the basket, which is really under pressure in terms of price rises, is the one which is being consumed.
So, Salman, what does it mean actually for some of your calls? I know I think you're still overweight U.S. equities. Where's the bottom for the S&P 500 at this point?
So overall, we are cautious. So our equity block, if you will, is underweight. So within that equity block, we have a preference for U.S. equities, especially on the value side of things. And we are underweight, for example, Europe and other regions. So it's a more of a nuanced view. And we are very negative on credit as well. Now, the question for us, as you rightly pointed out, is where is the bottom? So on average, in a recession type pricing, you would expect equity markets to go down between 25 to 30%. If there's a balance sheet type of crisis, then you can have much bigger sell-offs. So we think that the balance sheet, especially on the corporate side and the banking side, are in better shape. So we are getting into that territory where we have proper kind of recessionary pricing coming through, and this switch between bond prices, bond yields, and equity is a very important factor to watch going forward.
Salman, what kind of recession are you predicting? So if we're starting to price in a recession, it's different if you look at the 2007-2008 recession or if you go back to the 1990s.
So we are thinking about more of a version of 1980s, where you have real business cycle-based shocks. So the balance sheet protection or the strength which has come through on the banking side, we would expect that the shock will not be multiplied, and the central banks will be able to take care of any liquidity issues which may come through. So this becomes a much more of a natural slowdown as a result of inflation, as a result of the hawkishness from Fed's policy. So it's much more 1980s type template rather than the 2007-2008 template, which is a more balance sheet driven recessions.
Salman, overall, what happens if we're in a stagflationary environment? I mean, are we definitely going to see stagflation? And is there anything that policymakers can do to get out of it? Or are we going to be in a Japan-style 10 years of stagflation where no matter what you try and do, we see this kind of like really uneasy tension?
So I think stagflation for the U.S. on a sustained basis is not a given. Of course, this Fed is talking very hawkish. If you look at the financial conditions index, it has pumped through a sizable amount of tightening. So more than 200 basis points, despite the fact that the Fed is only starting to do actual actions, their narrative has been quite hawkish and the markets have responded. So there is quite a bit of tightening in the pipeline, and we are expecting that growth will slow down and take some of that heat out of the system, which will start to normalize inflation. But ultimately, it will depend on the Fed. If Fed wants to kill inflation, it can. The question would be at what price?
Salman, thanks so much. Salman Ahmed there from Fidelity International. He stays with us. We'll also talk about King Dollar, or certainly the dollar rally. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sri Lanka has gone into default for the first time in its history as the government struggles to halt an economic meltdown. The country's central bank chief says policymakers had told creditors the nation wouldn't be able to make payments until debt is restructured and is therefore in preemptive default. Soaring inflation has prompted mass protests and a political crisis in the country. Now, the U.S. Senate has confirmed Bridget Brink as the next ambassador to Ukraine, a move that comes after the country's embassy in Kyiv was reopened following a 3-month hiatus. Finland and Sweden, meanwhile, have formally handed in their NATO applications. However, Turkish President Recep Tayyip Erdogan has made clear he'll block the accession process over the Nordic nation's policy towards Kurdish groups that he does consider as terrorists. Closer to home, the UK Chancellor is warning that extra government spending to help ease cost of living pressures risks stoking even higher inflation. Rishi Sunak told business leaders there are tough months ahead for the country's economy.
At the same time, we need to be careful. As Tony rightly warned us this week, at a time of severe supply restrictions, an unconstrained fiscal stimulus does risk making the problem worse.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, stocks and futures swoon, bonds rally. I mean, more than swoon, they kind of sell off aggressively. We continue our conversation on the market turbulence next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in New York. Now, the market's falling out of bed following really some of the pressure that we saw in the S&P 500 yesterday. Yesterday was the ugliest day for American stocks in the last 2 years. The stock rout is deepening. Economic concerns are piling up. It's not only about the U.S. consumer, but of course, the idea that policymakers are really running out of tools to deal with this inflationary pressure. So European shares are tumbling. And again, if you look at U.S. futures, they're also signaling more losses ahead. Growing concern that high inflation is cutting into corporate performance. Still with us, Salman Ahmed from Fidelity International. Salman, I'm looking at some of these stocks. I mean, it's just ugly, ugly, ugly. Are there sectors, when do we know when some of the sectors actually hit a bottom? Or are there sectors where you still see value in Europe?
So on the European side, I think we are still focused on the healthcare sector, for example, which we think has defensive qualities, and there are some structural themes as well. Within some certain themes we think are starting to take shape. For example, cybersecurity. That's another theme we are focused on. It has come under a lot of pressure, but there is a structural shift towards a bigger demand for cybersecurity. So we are looking at some specific longer-term themes which may become come at a cheaper price, if you will, as the dust settles. And another one I can add to the lot is renewables, because as the energy security policies change in Europe, the push towards a longer-term move towards renewable will also increase. So there are opportunities arising, but of course, as you rightly mentioned, the short-term volatility and the pressure is an extreme one right now.
So, I mean, given, we had some pretty robust earnings and we thought that some companies or sectors were safe, that doesn't seem to be the case. Are we going to see a lot of volatility in the next couple of quarters until things settle, or you think it'll be a shorter-lived volatility bout?
So we are looking at two factors. The first one is the proverbial Fed put, how close we get to that Fed put. I think equity markets pressure itself does not take us closer to that Fed put in this cycle because inflation is so high. So we are looking at credit markets. They are starting to come under pressure. We think that pressure will continue to build up. And that's where we have to watch in terms of how closer we get to the point where the Fed says that enough is enough and there's enough growth damage in the pipeline to bring inflation down. So that's factor number one. And the number two is valuations themselves. But the fact is that in the US, we are back to the median of the last 5 to 10 years. So we are not in screamingly cheap territory yet.
But Salman, on that Fed put, and again, I had a conversation with Mohammed El-Arian saying there's no Fed put anymore given where we are in inflation. Is there a certain level in the S&P where you think that kicks in, even if it's not this year?
I think our thinking is this is a more of a multi-dimensional Fed put, and we'll be looking at credit markets rather than equity markets. So I do agree with him that probably this is not going to be geared towards some stocks coming down. But if credit markets come under pressure, there is sizable tightening further in financial conditions. The Fed will have to take notice, because ultimately, as things stand right now, they don't want a recession to bring inflation down. If it happens, it will be an accidental one, but that's where we are watching. This is the credit markets, and that we think will get us closer to the Fed put, not the equity market pressure on its own.
Salman, what do you do with currencies right now? So I was going to ask you about King Dollar and the dollar rally. I'm looking today, though, at haven currencies. I'm looking at yen, I'm looking at Swissy. I mean, they're seeing a bit of a bid. Is that a bit of a relief for some of the emerging markets? If we have an environment, we have inflation, maybe policy mistakes, and a higher dollar, there's a lot of countries, especially in the M space, are going to be in a lot of trouble.
I totally agree with you, Francine. This is a very toxic mix. If you are a commodity importer, on top of that, you have dollar going up. And of course, if your creditworthiness is also on the weak side. So we already are seeing examples of what's happening in Sri Lanka. There are other frontier economies which are also starting to feel the pressure. So, some respite on dollar would be good for the global environment. But so far, what we have seen is that dollar has moved in line with interest rate differentials. So the Fed hawkishness, which has been quite fast and aggressive compared to other central banks, has helped the dollar. But remains to be seen how it pans out going forward.
Salman, thank you so much. Salman Ahmed there, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Coming up, we'll have plenty more, of course, on these markets. If you look at the risk of economic slowdown, elevated inflation, and then these hawkish central banks, strategists are so cautious about what's coming up. We also talk cryptocurrency with PGIM's COO, Taimur Hayat. This is Bloomberg. Market rout, U.S. stocks suffer their worst sell-off in almost 2 years as growth fears pummel sentiment, while European stocks slide at the open. Supply chain shock, a warning from Cisco, and inflation pain for retail actually hammers sentiment. Growth warnings abound, while JP Morgan is the latest bank to slash its forecast for the U.S. as Standard Chartered downgrades China. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in New York today. Now, the markets just keep on getting slammed, and so we need to start the markets and trying to find a bottom for the S&P 500. I urge everyone who's a subscriber to the MLive blog to go and check it out. They have some really amazing things in terms of what it means for the markets going forward as we had this massive slump for personal care. Again, this is because of concerns about margin as inflation starts to bite. In FX, haven currencies such as the Swiss franc and yen are rising, the dollar declining, all G10 FX rising against the dollar, while the franc and Norwegian krona were the strongest among some of the peers. And then you see technology getting hammered over in Europe, with the European stock 600 down 1.7%. Now, I'm in New York because later today we'll also be speaking to Ken Griffin, the chief executive of Citadel, at the Bloomberg Intelligence Market Structure Conference. I know he'll have a thing or two to say about markets and volatility, so be sure not to miss that interview. Now, PGIM, the $1.5 trillion asset manager, is negative on crypto from an institutional investment perspective. Taimur Hayat, the COO, sees little real-world evidence that cryptocurrencies deliver diversification and that they're effective inflation hedges or even possess the characteristics of a safe haven asset. Well, PGIM COO Taimur Hayat joins us now. Taimur, as always, thank you so much for joining us. I can't believe I'm in New York when you're in London, but that's another matter. Talk to me about cryptocurrencies. I mean, what kind of role are they playing in these crazy markets where we're seeing a massive sell-off and so much volatility?
Well, I think they've actually confirmed lots of the things we've said about cryptocurrencies. You know, Bitcoin is a teenager this year. First trade happened in 2009. And they've proven that many of the things that we thought cryptocurrencies might do for us actually still don't play out. Do they work as sort of digital gold? They haven't been a safe haven asset. Do they work to protect us against inflation, Francine? Well, inflation's gone to 9% in the UK where I am today. And, you know, Bitcoin and the other cryptocurrencies are heading in the other direction. Do they have any stable correlations to act as a diversifier versus other asset classes that investors are in? There's absolutely a lack of stability, and I think that's proven even more so now, where they're basically acting as a sort of levered risk-on trade rather than a true diversifier of the portfolio. No. So I think that's just the beginning of the trouble for cryptocurrencies, because we still have the headwinds of regulation and central bank digital currencies, which will be quite negative for currencies in the future as well.
Timur, I love your straight talking. Tell me what you really feel on cryptocurrencies. But do they serve any purpose? Like, the markets are falling out of bed, and you know, compared to some of the other parts of the markets, is there an argument that says cryptocurrencies in the future will morph into something that could be used as a broader asset class?
Well, we never say never at PGIM. We look at what the data says. We've tried to torture the last 12 years of data on Bitcoin. And at the moment, there's no evidence of stable correlations, diversification, a real risk-return benefit that outweighs the drawdowns. But there are real opportunities, Francine, in the broader ecosystem. The sort of accidental innovation that happened in the creation of cryptocurrencies, blockchains, distributed ledgers, we actually see 4 or 5 pretty important investment opportunities that we do think long-term investors should focus on.
So, Timur, where do you see actually the value longer term for some of these things? I guess some of the non-crypto believers say the concern is that it's getting such sway in retail parts of the markets that it's just impossible to ignore, because a lot of clients want to know how they can get, in on the action.
I think on the cryptocurrency side, it's important for institutional investors, long-term investors, to avoid the FOMO, to avoid the momentum trade. It's fine as a retail investor if you want to speculate in this for a small piece of your assets, just like you might gamble on other things. But for long-term institutional investors, Francine, the real opportunities are in the broader blockchain universe, not in the gold, but in the sort of shovels and picks. And that's in smart contracts. Yeah. It's in private permissioned blockchains used by financial services company. It's in tokenization. It's in the infrastructure that central bank digital currencies will need to use that sort of underpins cryptocurrencies. And I think it's maybe just watching the metaverse space where there's a lot of losers, but maybe a couple of winners in the future too.
Timur, I love that. Avoid the FOMO could actually apply. Wise words could apply to so many things in life. Timur, give me a sense of actually where you see this market volatility and the market sell in the broader markets. Like, where do we find a floor on the S&P 500?
Yeah, I think, and we firmly believe, Francine, that we haven't seen the bottom of the dip yet, that this is just the beginning of a roller coaster ride. Everything is now driven by inflation. Central banks want to retain their credibility on inflation. And I think as that inflation journey spills over into monetary policy, fiscal policy, markets, there's room to go. And our fear is absolutely inflation is quite structural and embedded now. It's in housing, it's in other things that takes a long while to play out. But we also worry about, and I would think investors should be thinking about recession risk. Yeah. If central banks want to retain their credibility, they may go too far, too fast, and we may be in a recession already exacerbated by the war in Ukraine and other factors. So recession risk weighs on us quite a lot.
But Timur, is a recession now unavoidable? So we're seeing, I have, James from the news desk just sent me a story about chicken wings in the U.S. Pre-COVID, they used to go for $19. Now they're going for $34. Is this symptomatic of inflation that's out of control that leads to stagflation with monetary policy not being able to avoid a recession?
I think we'll all still hope, Francine, that somehow the central banks can engineer a soft landing and just kind of, create the Goldilocks level of rate rises to protect inflation, but not send the economy into a deeper spiral downwards. And let's remember, the US is in a much stronger place in terms of unemployment and growth than Europe or other Asian and emerging market economies. But I do think our base case is that given how late central banks have acted on inflation, how embedded expectations might become, that a recession is quite likely in the next 24 to 36 months.
So what's your haven par excellence, if there is one? It's unclear exactly what form that takes.
A safe haven right now?
Yeah.
We see a lot of our clients, certainly across PGIM, across our 1.5 trillion in assets sitting in cash. I think the best strategy right now is to be fairly risk-off, be in the more conservative part of various asset classes, and wait to see a very volatile journey play out.
Timur, if there's so much inflation and so much margin pressures in the U.S., how much worse is it going to get for the rest of the world?
I think Europe has the added pressure of the Ukraine war and energy prices and commodity prices that perhaps the US is a little more immune to on the energy side. So I think there's going to be a fair amount of embedded inflation in many countries, and you're already seeing waves of this hit emerging markets. You know, the global economy, despite all the talk of delinking, is still very interconnected, and we are seeing these inflation waves spiral into emerging markets as well. So I think this roller coaster ride has some space still to run, and I do think that we will have inflation as the central tenet of how markets move around the world for the rest of this year and much of next.
Timur, thank you so much for a great conversation. I mean, I know we plan most of our shows, but it's so good. We got lucky with you today coming on TV to talk about this market sell-off. Timur Hayat there, COO at PGIM. Now, coming up, imagine a world where autonomous cars take us to work, pick up our kids, and bring us groceries. Is that utopia or is it reality? That's the vision of a London-based company, Wave. We'll be joined by the chief executive, Alex Kendall, to discuss why the company is partnering with Microsoft. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in New York. The market's still falling out of bed. Yesterday, we had the ugliest S&P 500 day in about 2 years. The stock rout also deepening in Europe. Again, it's all about the concerns on the economy, and those concerns are, of course, piling up. Now, if you look at U.S. futures, they're also signaling more losses ahead amid this growing concern that high inflation is cutting into corporate performance. So we used to have some robust earnings bets, and that we thought would have helped investors weather the turbulence. But really yesterday, U.S. consumer titans signaled growing impact of higher inflation on margins, consumer spending, and that's really the bottom line of why some of these markets are freaking out. Now let's get straight to the Bloomberg Business Flash. She never freaks out. She's Leanne Gehrens. Hi, Leanne.
I was just about to say, you never freak out, Francine. Hi, and we miss you here in London. Now, EasyJet has reported a surge in summer bookings, but says there's still too much uncertainty over demand to provide an outlook for the fiscal year ending in September. The British budget airline says sales over the past 10 weeks are running 6% ahead of 2019 levels.
There's a huge pent-up demand for the summer, so we're seeing that in the bookings, and we expect to fly close to 2019 levels of capacity in our Q4, July, August, September. And the run rate of the bookings that we're seeing for the last 10 weeks, to give you an example, is way over and above what it was at the same point in time in 2019. So I don't think that there's so much concern really for this summer as such because of that pent-up demand. It's more about what this will mean going into next winter and beyond that.
Now, Target shares plunged the most in 35 years after it cut profit forecasts due to soaring inflation. The U.S. retailer's CEO says surging costs show little sign of easing. Operating profit is expected to come in at only 6% of its sales this year, 2 percentage points below the previous forecast. This a day after Walmart stock plunged on disappointing numbers. Bloomberg has learned the EU's top regulator has concluded global banks haven't moved enough senior staff from London into the European Union after the country split from the bloc. An exercise by the ECB known as desk mapping has found that several big lenders haven't built up sufficient local capabilities in the region. Reluctance among senior executives to leave London is understood to be one of the key problems. Cisco shares tumbled as much as 19% in late trading after it warned of a sales decline in the current quarter. The US maker of networking equipment blamed disruptions stemming from lockdowns in China and the war in Ukraine. The company had forecast sales growth of 6% this quarter, but now says revenue will instead fall by as much as 5.5%. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, Wave, W-A-Y-V-E, the London-based autonomous vehicles company, is partnering with Microsoft to leverage the supercomputing infrastructure needed to support the development of self-driving self-driving cars. Now, since it was founded in 2017, Wave has raised $258 million from backers such as Ocado and Sir Richard Branson. Now, through the use of machine learning, Wave says it's eventually aiming to deploy autonomous vehicles in 100 countries. Now, we're now joined by Wave CEO and co-founder Alex Kendall. And Alex, first of all, talk to me about this utopia world where there's an autonomous car that, you know, picks up my kids, brings them to school, drives me around whilst I can do my Zoom calls. Like, how far away are we from that?
Look, it's the future. I think autonomous driving is going to, it's going to be the first step in moving us forward as a society into the age of autonomy. And I think what's interesting about autonomous driving is it's going to be a really widespread application of embodied intelligence. And that's what we're really excited to be building at Wave. Embodied intelligence is taking artificial intelligence out into the real world and building systems that have the intelligence to interact with us at a really large scale. You know, we're talking about autonomous vehicles making their own decisions, driving around our cities, and ultimately letting us move people and goods in a more effective way.
Alex, that's also what scares people, right? It's basically the question if you're in a car and there's a child or you know, like someone else crossing a road, like what decision do you take if you have to swerve? How concerned are you that regulation, and of course the fact that this needs to be safe, will delay it by decades?
I think we're really excited and encouraged to see what's happening on the regulatory front. So the UK government announced last week in the Queen's speech that this is something they're going to be legislating for in this upcoming parliamentary agenda. But I think more importantly, it is going to be disruptive. It's going to completely change how we move around. But I think the benefits are unparalleled, and that's something that we really need to lean into. If you think about the economic benefits, more importantly, the safety, and most importantly as well, the sustainability you're going to get from autonomy, that's what we're really excited to unlock.
So, Alex, who's your biggest rival right now? And I guess when you talk about autonomous cars, you know, is the big winner the people that create the software, or is it the ones that will actually make the end product, the cars?
A lot of people think it's about building cars and automotive technology, but actually it is fundamentally a technology problem that's stopping us today deploying autonomous driving at scale. I think this has been a sector that you often can relate it to being a space race of our generation, because it's a multi-decade generational problem to solve. And we've seen some fantastic efforts, really pioneer this space, particularly from North America. But fundamentally at Wave, we're taking a different approach. And we see that this approach using machine learning to scale the technology is really what's going to let us deploy this in over 100 cities.
But so, you know, it'll make a difference if you partner further down the line with Tesla to a Volkswagen. Like, how do you think about partnering in the future?
We see this as we see our technology as being a very adaptable autonomous driver. So we can deploy a driver as a service to commercial fleets. And the commercial fleets we work with, so today we partner with DPD, Ocado Group, and Asda, three of the UK's largest and most technology advanced fleets. Mm-hmm. And we see all of our fleet customers having very different requirements for the actual vehicle they need to operate. And so what we're building is a really adaptable driver that can give them the mobility services they need to make their services most effective.
So Alex, give me a date. When am I going to be like sitting in my car like this, just like reading and, you know, like this, speaking to my producer about what's coming up on the show instead of having to do any of the driving?
Look, this is a really hard and challenging problem, and I think the industry has been plagued by false hype and expectations. When we started the company in 2017, we were told from big tech this was just going to be a year away, and I think that we're discovering this is a really challenging task, but I think with a lot of what we're seeing today, a lot of the ingredients are coming together from regulation, technology, public acceptance, and the commercial environment to make this possible. So we're going to see this technology really come to age this decade, but I'm hesitant to give a specific timeline around this. We're working on it as hard as we can.
Okay, Alex, come back in 6 months and then we'll have an update. I need a date for when my life gets a lot easier. Alex Kendall there, Wave Chief Executive Officer and co-founder, joining us today. In the meantime, the markets, especially in Europe, still going through this rout. We saw it yesterday with the U.S. indices. U.S. futures today still pointing to more losses ahead amid this growing concern that high inflation is cutting into corporate performance. Now, this is a picture across the board. When you look at all of the industries that make up the Stocks Europe 600, they're all on the downside. Coming up, over a year after the retail short squeeze, and its biggest victim is closing its doors. More on Melvin Capital next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in New York. The market's really falling out of bed. I'm seeing quite a lot of chatter that actually there's going to be a lot of companies and a lot of banks having to lower their forecasts, not only for the economy, but certainly get inflation forecasts up. Now, the rout that erased $1.5 trillion, think about that, of market value from U.S. equities yesterday seems to be deepening today. European shares tumbling, U.S. futures signaling more losses ahead. There's more and more growing concern that higher inflation is cutting into corporate performance. Now, more than a year after Gabe Plotkin's Melvin Capital Management was hit by a short squeeze by amateur traders who organized on Reddit, the $7.8 billion hedge fund is giving up and now shutting down. Well, joining us now with the very latest and some of today's other big finance story is Bloomberg's Charlie Wells. Charlie, good morning to you. So how did things go so wrong for the fund that now they just have to close shop?
You know, Francine, there's a saying that the first cut is the deepest, and I think that really was the case with Melvin Capital. So we go back to a strange time called January 2021. We see that short squeeze, and the fund was down 55% that month. They managed to recoup some of those losses over the course of last year, ending the year down 39%. But these past few months with markets in such bad shape seem to have proved just too difficult for the fund to recover from.
So if you look at what that means for other places in the space, are there places, Charlie, where we should worry that the same thing could happen going forward?
Yeah, so the street has been very concerned about the health of hedge funds, particularly over these past few months, particularly equities hedge funds. We've talked about how that strategy has just not been paying off over the past few months. You look at Melvin Capital's book, you see in that first quarter, 5 of their 6 largest holdings were down, at the end of quarter one, were down double digits this past month, and that 6th was down 8%. So that equity strategy was just so risky and just seemed to not pay off here. That's the concern that it could be a larger problem across the space.
Charlie, we've had a news, of course, on probe into private messaging in banking. What are the details and how damaging is that?
Oh, yeah. So this is another concern hanging over not just funds, but also banks. So it's Deutsche Bank's annual general meeting going on today. They have concerns about private messaging on platforms such as WhatsApp. So over the course of lockdowns, bankers and other traders use platforms like WhatsApp. And the concern by regulators on both sides of the Atlantic is that business activity was conducted over these platforms. Hanging over the industry is a $200 million fine that U.S. authorities levied on JP Morgan, and a lot of other banks are worried about that, conducting internal investigations and saying as well that they're cooperating with U.S. regulators who are expanding a probe.
Yeah, so Charlie, I thought actually WhatsApp had been banned by so many banks. Just go back to the IB guys on the Bloomberg terminal. That's compliance, right?
I think that's a good idea. And what's really interesting is we're seeing some banks roll out new technology to actually allow their staff to continue to use some of these platforms. And that differs from a few years ago. Say 5 years ago, Deutsche Bank banned WhatsApp, but now they're trying to figure out how to use it in a compliant way. But, you know, IB could be a good solution there.
There you go. Thank you so much. Our Charlie Wells there with the very latest on some of the banking. And actually, it's really, really hard to get all of your staff on one messaging group that's good for compliance, especially when WhatsApp is just so popular. Back to the markets because they're falling out of bed. Yesterday, we had a huge, huge sell-off. $1.5 trillion in terms of valuation being wiped off. The ugliest day for the S&P 500 in 2 years. And there's no real sign of the bottom or of us hitting bottom right now. The European stock 600 down some 1.7%. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz here in New York, and Edwards is in London. They have much more on the Bloomberg market route, so they have much more on the dollar. We see a demand for havens, currency havens, such as Swissy, but also yen. This is Bloomberg.
Next year is really the difficult year, but it could come again. There are things that can make it come forward.
You're seeing the earnings misses are starting to come in.
We actually find ourselves in a pretty defining moment now.
It's going to be a rocky road.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, May 19th. Our top stories today. No end to the sell-off after that $1.5 trillion meltdown. U.S. futures signal it will be another tough day for those holding stocks. European stocks are also in the red. Calling it quits, Gabe Plotkin is shutting down his Melvin Capital hedge fund more than a year after it was hammered by amateur traders in a short squeeze. And a warning from Beijing. China tells the US its increased support for Taiwan will lead to a dangerous situation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Matt Miller is off today. Well, Kailey, after yesterday down more than 4% on the S&P and the Nasdaq, it's gone around the globe and it continues here in Europe and into U.S. futures.
And it continued in Asia as well. You really saw equities there following on the losses we saw in the U.S. yesterday. The pain just isn't stopping. The MSCI Asia Pacific Index falling about 2% overall overnight. That was a loss led by Hong Kong, which was a loss led by technology specifically. The Hang Seng Tech Index down about 4%. A lot of that had to do with one stock in particular, which is Tencent. Of course, it reported its earnings after the close of Asian trading on Wednesday. Its slowest revenue growth since 2004. Plus, executives of the company said that let up on the Chinese regulatory crackdown isn't going to happen in a fast fashion. It's going to be a slow process. So that is hanging on sentiment more broadly and hung, of course, on Tencent stock, which was down about 6.5%. The other story we are continuing to follow in Asia is the situation in Sri Lanka. Inflation there, of course, accelerating rapidly, could surge to 40% in the coming months, according to the country itself. And now the country has fallen into default for the first time in its history after it missed making the payment during the grace period on $78 million worth of coupon payments. So you're definitely seeing that ripple across the Sri Lankan bond market. That dollar bond due in April 2024 now trading at just 39 cents on the dollar, Kriti.
Yeah, Kailey, that risk-off sentiment, it is clearly translating into early trading, at least when it comes to stock futures. And you can see that in the 1.5% decline you're already seeing in futures. And just in the last 30 minutes, you've seen that really accelerate. We started off, I believe, the European session, Anna can expand on this, but we started off the European session about flat. So this conviction selling really is coming online from European traders and potentially American traders who are getting an early start to their morning. Nevertheless, take a look at what's happening with the Treasury market. Bonds taking a little bit of a bid. The yield down by 5 basis points. And that risk-off momentum, you can see it really translating into crude down 1% and Bitcoin as well down 0.8%. Now, in a volatility-adjusted context, I love to say this, those aren't massive moves, but the fact that it is tilting downwards tells you that already some of that stock sentiment, it is filtering into some of the other assets, Anna. Yeah, Kriti, to your point, sentiment has been worsening as we've been going through the first couple of hours of the European trading day, and some of this is backward-looking. We closed down here in Europe, down 1.5% or so on those big benchmarks of European stocks, and so we had some catching up to do, perhaps, with some of the U.S. Wall Street story. But some of this is forward-looking as well, and as we've seen U.S. futures weaken, we've also weakened here in Europe. So down by more than 2% on the CAC 40, the FTSE 100, and the Xetra DAX over in Germany. And in terms of those sectors to the fore, all sectors are in negative territory today, but no surprise that we see retail doing really badly today. We also see personal care, that grocery sector, anything that's really consumer facing. Those are the areas where we're seeing some weakness coming through. And so it's that sector that is down by 3.4% today. Here's a stock specific for you, but it does tap into some broader themes. Royal Mail, parcel delivery business here in the UK, as maybe the name suggests. That stock down by 12%. They missed earnings estimates, and that again is another theme that we're increasingly talking about as we've gone through the most recent part of the earnings story. Missed estimates, also warning that they won't be delivering so many COVID-19 tests to people's homes. They won't be delivering so many parcels, lockdown parcels to people, and that plays badly for the business, of course. I wanted to put in what's going on the Swiss franc. This is the Swiss franc rallying up by 1.3% against the US dollar. We're seeking havens today, seeking havens in the bond market. We see that here on the German Bund yield. Seeking havens there, also seeking havens in FX, around the yen, around the Swiss franc. Not interestingly, Kailey, around the dollar. That phase where the dollar acts as a haven, as we were watching interest rates go higher, we seem to have turned a corner to a new phase where it's all about growth, something they've been talking about on the Markets Live blog for some weeks now.
Yep, a growth scare is really what it looks like it's all about today. Now, as for what else is ahead today, Kohl's will be reporting its first quarter earnings before the bell. So another retailer, of course, it fell 11% yesterday in sympathy with the declines we saw in Target. Will be interesting to see how this company is faring in the face of inflationary pressures. Then at 10 a.m. New York time, the Senate Banking Committee will hold a hearing for Michael Barr, President Biden's nominee for the Fed's vice chair for supervision. And finally, speaking of the Fed, Minneapolis Fed President Neel Kashkari will be speaking at 4 p.m. New York time, Creedy.
And U.S. stocks, they are poised to slide further after the benchmarks on Wednesday had their worst day since the 2020 pandemic. That's on concerns about slowing growth amid soaring inflation and tightening policy. Let's break it all down here with Bloomberg's Danny Berger. Danny, a scary and I would say volatile, scary and volatile session. Walk us through what happened and what this means for today's session.
Creedy, it does feel like it's becoming less about these incremental stories of big box retailers, of whatever Jay Powell is saying. It feels more like the trend is in, and that trend being 1 step forward, 2 steps back. A sell-off continuing after the worst day in 2 years yesterday, this morning. And for some, this is a feature of what's happening with monetary policy, not necessarily a bug. Jay Powell said it himself earlier in the week that the market sell-off, it's been orderly and the correct response to trying to tighten financial conditions to get inflation under control. And there's some degree that the market is buying that they're buying what they're selling. And to that point, we have seen 10-year break-evens back off from the high of 3%, more than 3%. They've started to drop. So maybe there is an expectation that the Fed can choke off inflation faster than expected. But that means the question doesn't turn into how long does inflation persist for? It's what are the ramifications to growth if indeed we are able to get inflation under control?
And where does this take us on treasuries then, Danny, and the latest thinking here? Because for a long time, we concentrated on that bond market sell-off, on the Treasury sell-off. We've seen yields rise. And interestingly, we went above 3% yesterday, and that was enough. People stepped in.
Totally. Well, I think that sets it up really nicely because there's 2 aspects to it. And JP Morgan Asset Management's Matt Gorain really sets this out, saying that 1, as you said, gets to 3%. That's enough. There's some technical element to this, that we're on track for the worst bond market rout on record. And so perhaps the low is in, the Fed, all that hawkishness, it's already priced in so you can go in and buy. The other element to it, which JP Morgan talks about as well, is the growth scare. If we're shifting away from fear of inflation to fear of growth, then all of a sudden bonds look attractive again as a hedge. And I should say these recessionary calls, they're stacking up from JP Morgan, as I say, to Wells Fargo, to Goldman. So it might be an environment where, yet again, bonds work.
Bloomberg's Danny Berger, thank you as always for breaking it down. Let's go from markets to the market players. Gabe Plotkin is shutting down Melvin Capital after the $7.8 billion hedge fund failed to recover from last year's meme stock frenzy. Our global finance correspondent Sonali Basak joins us now for more. Sonali, walk us through what actually happened here, because this was such an important story a year ago. About a year and a half later, a kind of sad end.
Yeah, certainly a sad end. What had happened was, remember, Gabe Plotkin was a star, and he was known for making really amazingly profitable short bets in the middle of a rising market. Then there was the Reddit fuel short squeeze. We knew he lost a lot of money at his hedge fund that month. He was able to recover last year quite a bit, though still ended the year down significantly. Then there was this year. This year really was where things started to topple over, as 23% decline you saw in Melvin's hedge fund through the end of April. Guys, I think the $1 million question in the room is this going to be the only fund wind down we see this year? Certainly it was a couple of years of pain, but this year you are seeing drawdowns that are much bigger than what you saw at Melvin this year and throughout last year alone.
Yeah, he's certainly not alone. The Tiger Cubs are suffering as well in a big way. That's kind of what's going on in the world of traditional finance, if you will, Sonali. In the world of decentralized finance, a story you and I have been following for weeks now is the utter collapse of Terra USD and Luna. We've been waiting for one man to chime in on this, Mike Novogratz of Galaxy Digital, and finally we have heard from him.
Yeah, Mike Novogratz had been talking about Luna for a long time, but the thing that weighs heavily here about the Luna UST story is not the institutional investors, but how many retail investors were in Luna and UST. And that's what Mike Novogratz had said in an open letter yesterday. There's no good news that in what happened here, and the question here is, how do you move forward when so many people lost their savings in Luna and UST? But I've got to say also, when it comes to Mike Novogratz, he talked about that tattoo, as you saw pictured there, and that being a constant reminder of venture investing requiring humility, which is a lot of things that a lot of big hedge fund managers are feeling right now.
Shanali, thanks very much. Bloomberg Shanali Basak on a couple of important financial stories, hedge fund stories and crypto there. Now, China has again warned the United States about its increased support for Taiwan. In a phone call with the National Security Advisor Jake Sullivan, China's top diplomat said the U.S. is going down the wrong road, and that could lead to a dangerous situation. Jack Fitzpatrick, Bloomberg government reporter, joins us now from D.C. with more. So China giving this warning. How is this going to go down in the U.S.?
This is a little bit more of the same from China, so it's not a shock. It is strong language, especially the use of the phrase dangerous situation. But it really shows what a priority this is for China to try to push back on the U.S.'s relationship with Taiwan and any increasing support. This was the highest level discussion between the U.S. and China since the Xi Jinping-Joe Biden conversation in March, and President Xi raised the issue then as well. So clearly it's a high priority, something China really wants to push back on. And keep in mind, of course, President Biden at noon today is supposed to start traveling to East Asia, first South Korea and then Japan. And of course, China looms large over anything the president does when he turns his focus to East Asia. So this may not be the last news out of the White House with regard to China. And obviously, Taiwan is the most sensitive topic within U.S.-China relations.
Jack, as you said, China's warning comes as President Biden does prepare for his trip to Asia. What else is on his agenda ahead of his travels?
Before he leaves, he is going to meet with the leaders of Finland and Sweden. President Biden has endorsed their move to try to join NATO. There are some issues with that. Turkey trying to hold it up over issues regarding Swedish support for certain groups, Kurdish groups. So there's a bit of a back and forth. The president is going to meet with the leaders of Finland and Sweden or meet at the White House with them today. And actually, meanwhile, on that topic, there are conversations between U.S. Secretary of State Tony Blinken and the Turkish foreign minister regarding that accession process with Finland and Sweden as it relates to NATO. So that is another serious priority, obviously with an eye toward Russia and its invasion of Ukraine and any threats felt by Sweden and Finland's leaders.
All right, Jack Fitzpatrick of Bloomberg Government in Washington for us. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A big underperformer in early hours is Cisco Systems. It reported after the bell yesterday, and it warned that revenue could fall up to 5.5% in the current quarter. The company blaming a few supply-side challenges, including the COVID-19 situation in China, as well as the war in Ukraine. They say that will weigh on sales, and that stock getting weighed down heavily in early hours this morning, down almost 14% before the bell. And of course, the big earnings-related mover yesterday was Target. Had its worst day since Black Monday, 1987, after it cut its forecast. It was down a whopping 25% in the Wednesday session. On this Thursday morning in early hours, it's down another 2%. So no relief is coming in this morning. And of course, Target also weighed on some of its retailing peers in yesterday's session. That included Kohl's, which fell 11%. It's going to be reporting its earnings in just a couple of hours later on this morning. But ahead of that report, it already said that two of its executives, its chief marketing officer and chief merchandising officer, are going to be leaving the company effective immediately. So before it's even reported, Anna, that stock already is down about 5% before the bell.
Yeah, absolutely. Really perfect voice to talk to about all of these market moves coming up on the program. We'll talk about the stock sell-off with Matt Maley, Miller Tabak, Chief Market Strategist. If yesterday was all around concerns around the U.S. consumer and retail, well, the Cisco numbers certainly reminding us that there's also the China worries, the Ukraine concerns out there as well. We'll also speak to John McClain, Brandywine Global Portfolio Manager for High Yield and Corporate Credit Strategies. What clues are we getting there as to whether we're headed for a hard landing for the U.S. or global economy? Plus, high inflation and disrupted supply chains from Russia's invasion of Ukraine and China's COVID-0 curbs could just be the start. Today's big take story assesses the damage that would stem from an accelerated reversal of globalization. Read more by typing NI Big Take into your terminal. This is Bloomberg.
Breaking news on NATO. Turkish President Recep Tayyip Erdogan says that Turkey will say no to the addition of Sweden and Finland to the alliance. This is according to a video he has posted on Twitter. Erdogan saying that Turkey will not make the same mistake as with Greece on NATO, again saying that he will vote no for these two countries entering the alliance. And of course, Creedy, President Biden will be meeting with Finland's president and the Swedish Prime Minister at the White House later today. So I'm sure we will continue to get developments on this story throughout this Thursday.
Yeah, Kailey, lots of geopolitics at play. And of course, we know Turkey has a very long history with Greece. So we've got to take everything with a little bit of a grain of salt. But let's go back to the markets here, because that sell-off, it does continue. But I want to look at it from a valuations perspective. For our radio audience, stick with me here. When we're talking about selling off from the stock market, specifically in tech, one of the big concerns, or one of the perhaps topics that wasn't really in the conversation, was what is tech valued? In this era of thematic trading, do we really care what the valuations are when they simply play this role as a safe haven? Well, we care now, because those valuations are coming back now globally to similar valuations to consumer staple stocks. So that defensive play that's in tech has kind of moved that defensive play in consumer staples. It's interesting as we see what actually is going to catch people's attention and get investors to buy the dip again. And for that conversation, let's bring in a true expert, Noor Al-Ali, our Bloomberg Markets Live editor. She joins us now. Noor, let me put that to you. We're in this kind of fear-driven environment. What will it take to see the dip buyers emerge?
It's going to take a lot, and there's not a lot out there that's going to help the dip buyers to emerge. I think some sentiment might be swayed. If you see valuations really trickle down, a lot of people will tell you, oh my God, look at these valuations. We were dying for them just a couple of months ago, and now they're here. So there is some perception of that, but I'm not very hopeful, because you do have quantitative tightening beginning in June. So we haven't even really started with the push from the Fed to limit the money supply that's in the market. And I mean, you are looking at some old tech pros. So IBM actually year to date up 2%. So some hopefulness maybe there.
Noor, good morning. What seemed notable at the start of the European trading day was we were starting to sell off, and that's gained momentum. We're now selling off more and more across European stocks this morning. But it seemed to be a stock story. Now it's very much an FX story as well. So the havens that we've had, the dollar has played such a role as a haven in recent months. But that's changed. And that's something I know the Markets Live team have been talking about a lot, the role that the dollar will play. Now we're buying the yen, even buying the euro, even buying the pound and buying the Swiss franc.
Yeah, I'm not too hopeful about the pound, but look, Japanese yen, absolutely very interesting story there. Swiss franc rallying on its own merits as well, because we are assuming that the central bank governor there is going to use a stronger Swiss franc to pull up rates. And, you know, when you look at the yen right now, there's not a lot out there. The dollar has definitely lost that steam that we've been looking at for the past year. So the FX market is definitely leading it, going back to those traditional havens that we're used to.
Where else are we seeing that show up, Noor? Are bonds once again acting as they are designed to in a 60-40 portfolio?
At the moment, they are, because we're taking cover. So we're sheltering away from basically the massacre that we're seeing in stocks at the moment. But I'm not too hopeful when it comes to the bond market either. But right now, when I look at the markets, I say this is a volatility play. You know, if you're able to know where the volumes are going to go and where the tides are headed, you can come out a winner here. But right now, I think bonds are definitely going to extend declines. I know that I've got some of my peers in the team who probably think that we've bottomed out in some of these shorter end maturities, but I think we're definitely going to see the pain coming into the summer even more.
Okay, it takes at least two views, many more perhaps. Noor, thank you very much. Thanks for joining us. Noor Al-Ali of Bloomberg Markets Live. And for more market analysis, check out the Markets Live blog, MLIV Go. That is the function to use on your terminal. They have been talking about this changing role for the dollar for some time, and I know they'd love to hear from you. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Sri Lanka has fallen into default for the first time in its history. Policymakers had flagged to creditors that it would not be able to make payments within the grace period. Sri Lanka's government has been struggling to halt an economic meltdown that has prompted mass protests and a political crisis. Authorities warn that inflation may hit 40% later this year. President Joe Biden has invoked emergency powers under the Defense Production Act to try to boost production of baby formula. He's also ordered that government planes be used for imports. The baby formula shortage has emerged as the latest crisis for the White House. It's been months in the making and could ease soon when production restarts at a key plant. Senate Democrats want President Biden to go big with student loan forgiveness. Senate Majority Leader Chuck Schumer and Senators Elizabeth Warren and Raphael Warnock met with the president at the White House. They want $50,000 in student loan relief. That's 5 times what the president has indicated he would support. And the world's richest person saw his wealth shrink by more than $12 billion in just one day. Tesla fell to the lowest level this year yesterday, knocking Elon Musk's fortune down below $210 billion. Musk has lost $49 billion since launching his bid for Twitter last month. In part, investors in Tesla are concerned about how Musk will fund the Twitter bid, but the wider market sell-off also has played a role. And of course, Anna, that is a sell-off that is continuing this morning and one we're going to discuss more coming up.
Yeah, absolutely. That sell-off continuing here in Europe. We're down by more than 2% on the stock 600. So those losses gaining momentum as we go through the European session. US futures also pointing lower by more than 1% on all of the major indexes. We will discuss that with Matt Maley, Miller Tabak, Chief Market Strategist, from concerns around US retail and the profits of US retailers to a broader growth concern that seems to be gripping markets. What happens next? We'll talk about that. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. No end to the sell-off after that $1.5 trillion meltdown. US futures signal it will be another tough day for those holding stocks. European stocks are also in the red. There's growing concern that soaring inflation is hurting corporate earnings. Gabe Plotkin is shutting down his $7.8 billion hedge fund, Melvin Capital Management. More than a year ago, the fund was hammered in a GameStop short squeeze by amateur traders who organized on Reddit. It never fully recovered. And a warning from Beijing. China tells the US its increased support for Taiwan will lead to a dangerous situation. Earlier this week, the top American naval officer said Taiwan must prepare itself against potential Chinese aggression through military deterrence. I'm Anna Edwards in London with Chrissy Gupta and Kailey Leinz over in New York. Matt Miller is off today. And Chrissy, after the pain in retail, it started in retail, went broader than that, of course, hit big tech in the US, and then it went global. And now there's just a general concern about global growth.
Yeah, well, the decline continues today, and this is interesting because after such a big decline that we saw yesterday, the natural assumption here is that you would see something of a rebound just in terms of pure technical plays, but you aren't actually seeing that. In fact, you are seeing a decline of 1.5%. It brings us back to the volatility of a couple of weeks ago. We did have a few weeks of perhaps a little more calm in the markets, but nevertheless, today it is a risk-off tone. But here's what's different about the selling that you haven't seen in past months. The 10-year yield continues to catch a bid, or continues to drop. I say Treasuries continue to catch a bid. 282 on the 10-year yield, down 5 basis points. And look what's following it, the dollar. This is important as we talk about foreign investors hopping into the U.S. stock market. Traditionally, as you start to see stocks drop or futures drop, you would see a stronger dollar, essentially disincentivizing investors to hop into the market. Now the dollar is actually following the yield dynamics instead of anything else. So this is going to be a really crucial beacon to watch. But to really cement that risk-off feeling, let's take a big look at Bitcoin, our ultimate risk-off sentiment indicator, down 1.2%, Kailey.
All right, Creedy, well, let's take a look beneath the surface as well, because there is some real pain out there in the equity market at the individual stock level, including for Cisco Systems, which reported earnings after the bell yesterday. Of course, reporting into a pretty tough market. Sentiment already was pretty dire, and then the company saying that revenue could fall as much as 5.5% in the current quarter didn't go over so well. Of course, it's blaming China and the war in Ukraine for supply-side challenges as the reason why. Nonetheless, the stock is down 14% in early hours as a result. And of course, you had Target down 25% in yesterday's session, its worst day since Black Monday after cutting its forecast. Those losses continuing this morning, but the stock down the better part of 2%, and that is rippling through to other retailers, including Kohl's, which was down 11% yesterday. It's down another almost 6% this morning before its results. And of course, ahead of those results, announced that 2 of its key executives are departing. And then finally, Creedy was talking about how that rippled, and Anna was as well, rippled from retail through to big tech. And once again, you are seeing technology stocks under pressure in early hours. Apple is down about 1.5% before the bell, Anna.
And Kailey, here in Europe, we're seeing all sectors under pressure to varying degrees, of course. Utilities a little bit more resilient, but all sectors in the red. And we see the stock 600 down by just over 2%. So factoring in a little bit of yesterday's move here in Europe, yesterday on Wall Street, putting that into the European context, but also looking at those US futures and responding accordingly. There is broadly a concern around global growth. There's also a concern about consumers in the US and here in Europe now as to how they stand up with these inflation or stand up to these inflation pressures. And just to untangle some of the acronyms on here. This is personal care, drugs and grocery stores. And that is a sector all in one together here in Europe, and it is weaker by 3.6% today. Is consumer-facing businesses, that and retail, that are doing badly in this session in particular. Financial services, though, also not doing particularly well with the sell-off that we're seeing in stocks. This is the Swiss franc gaining, and as we were hearing from Chrissy, we're not seeing money going into the dollar. It seems that haven play that the dollar was performing, or that haven role it was performing, that's changed a little bit in recent days as we've started to be more concerned about growth and maybe the inflation and the higher rates environment. And the higher rates environment certainly something we need to not lose sight of. But at the moment, it's taking a pause as we're seeing buying of treasuries, we're seeing buying of sovereigns, and we see that down here with the German Bund as a result of it being a bit of a haven play for us this morning. Then, Kailey.
Yeah, markets behaving as you would expect they would in a risk-off day. So that raises the question of whether or not this is really capitulation. Joining us now is Matt Maley, Chief Market Strategist at Miller Tabak. Matt, thanks for waking up early for us. When you look at these markets, yes, it has been painful. Yes, the worst day for equities in more than 2 years is nothing to sneeze at. Yet I'm looking at a VIX that's still at a 32 handle. Yes, relatively elevated compared to history, but it's not a blowout like we've seen in the past. Things look pretty orderly. So how far away are we from real capitulation?
Yeah, it's one of the things that the last thing you want to hear is that it's a disaster, but an orderly disaster. You kind of want that, that big capitulation washout move. The one thing we did see a little bit of that yesterday was the breadth. The advances versus decliners was very, very negative yesterday. So that's starting to give us a sign that, it was 50-1 in the NASDAQ 100 and like 30-1 in the S&P 500. Those very, very bad numbers. However, the volume really wasn't all that big. And so it wasn't anywhere near as big as even just last week. And so we really haven't had that big washout move. Now, can we get a bounce? So, of course, we can get one at any time soon. It does look like we want to retest those intraday lows from last week, and we've already broken the closing lows, but the intraday lows, and we'll see if we get a little bit of a double bottom. But now this news out of Walmart and Target has really got people focusing on what earnings are going to look like for the rest of this year, and that's starting people really concern people.
And yet, Matt, the bulls are still the bulls. Marko Kolanovic over at JP Morgan saying that stocks can climb out of this hole. We can get there. We can do it. Where are you in that camp? How optimistic are you?
Well, I just think that, it's going to be very, very difficult. One of the things that I've been talking about for a while is that you go back from what the, all the big firms on Wall Street, Goldman, because they cut their GDP estimates again this weekend, but, they've cut since last October, they've cut their GDP forecast in half. And that's pretty much what everybody on Wall Street has done. However, nobody's cut their earnings estimates. How can you cut your numbers in half and not cut your earnings estimates? And now what we see that what the impact that inflation is having on margins, people realize this is going to be something that's going to happen. And therefore, even though the market has revalued itself, it may have to revalue more because the E part of the PE ratio is going to come down.
Matt, good to see you. I wonder where you think this goes next, because if you're looking at the earnings stories that the market has really moved on, and you've cited some of them around retail, that's been a big concern, and how the consumer holds up in the face of higher inflation and how those margins hold up in that sector. But then we got numbers from Cisco overnight underscoring that there are other challenges out there. They were citing concerns about China and what that's going to do to their ability to generate sales. How concerned are you that this doesn't just stop with concerns about US retail?
Yeah, I definitely agree. And what we're talking about here is that, again, we have a situation where the Fed was too late in pulling in its horns last year. They were wrong about being transitory in inflation. However, things have gotten even worse, and they really couldn't have foreseen the not just a war in Ukraine, but a war of attrition. That means oil prices and food prices are going to stay higher, and it's going to have an impact on the supply chain issue. And of course, now we have China with the new lockdown, so that's another thing on the supply chain issue. I mean, remember this time last year, everybody was saying the supply chain issue wouldn't be a problem after 2021. Now we're saying it's going to go into 2023. So you're absolutely right, Anna. It's an issue that's broad-based.
Okay, so we keep focusing on that. And with all of these headwinds in mind, Matt, I mean, is it, with what we know about the Fed and how laser-focused they are on inflation, it seems maybe silly to ask you about whether there's a Fed put here. But if there isn't a level of stock sell-off that would trigger the Fed to change course, if they're okay with stocks looking like they're heading into a bear market, if they're okay with that, is there a level of something happening in high yield or something happening in credit spreads that we need to watch out for that might trigger the Fed to change course?
You mentioned high yield, and you're spot on with that, because this is one of the things that, again, I've been talking about all year, is that people made the mistake of saying that, hey, back in 2018, the Fed pivoted when the stock market was down. They didn't. That's actually not accurate. And I've been talking about this for months, is that in 2018, in December of 2018, the stock market was down 13%. And they went ahead and raised rates again. They didn't care about the stock market. It wasn't until just a few weeks later that the high yield market really started to implode. That's when they started to freeze up there. That's when they really started to change their stance. So, again, I guess my point is, yes, there's a put out there. It's lower, but they are market dependent, but they're fixed income or bond market dependent much more than they are stock market dependent. The stock market can go down quite a bit without really hurting the economy. When the bond market starts freezing up, that's when you have the problems. And right now, the bond markets, even though they've gotten hit quite hard, they're still running quite fine. And that's, again, that's a concern that they'll let it fall further still.
A very key point, Matt. One of the consequences of that Fed put that you were just discussing was this: there is no alternative kind of mentality. I'm curious, though, if that returns in the face of potential recession in Europe and these COVID lockdowns in China. Do we start to see the American stock market just rally off of purely capital flows?
Well, I mean, it certainly could, and we can see what's going on with the dollar. It continues to not just hold up, but rally nicely. And as you mentioned earlier, the issue, people are now the dollar was the flight to safety rule, the flight to safety trade. Now we're seeing it in the bond market as well, with bond yields coming down and bond prices moving up, because again, that's something where people are more comfortable with. The U.S. Treasuries are backed by the full faith and credit of the United States government, and that's why they like that. And it's interesting, too, we still haven't seen a bid in gold. It's been holding up here above 1,800. I don't know if it'll rally further, but, there's been a traditional flight to safety trade. It hasn't been yet. But at some point here, I would think gold would catch a bid as well.
Just up 0.5% this morning. Matt, thank you very much. Thanks for joining us. Matt Maley of Miller Tabak giving us his thoughts on the sell-off that's been and perhaps still to come. Coming up on the programme, we'll get to a conversation. We'll dive deeper into those comments we were just hearing there about credit. John McClain joins us, Brandywine Global Portfolio Manager for High Yield and Corporate Credit Strategies. Great voice to get on a day like today. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz over in New York. Now, Goldman Sachs CEO David Solomon says clients are preparing for slowing growth and a decline in asset prices thanks to high inflation. And he warned that if the tumult spilled over into credit spreads, it would be, quote, concerning. Joining us now to talk about credit spreads, John McClain, Brandywine Global Portfolio Manager. So it's interesting to see someone like David Solomon saying that that's, something he's watching for. That's what he's focused on, as many people look around to see if we're seeing signs of recession. Do you see things in credit markets that make you concerned about a U.S. or global recession?
Well, I do think credit markets are very important here, and credit spreads are the canary in the coal mine, because the Fed doesn't care about your 401k, but they do care about functioning credit markets. So as we are seeing spreads starting to widen and accelerate on that widening, I think that definitely bears attention. we would say that, probably 650, 700 basis points in terms of spread in high yield is where I think the Fed is going to be really paying close attention.
Okay, and where are we now then, John? Where are we away? How far are we away from that? And what kind of reaction function would that bring about in the Fed, do you think?
Yeah, so I mean, we're rapidly approaching 500 basis points. And really, outside of COVID, the last time we got to 500 basis points was really the end of 2018. So we don't see that type of level, very, very frequently in the marketplace. And I think what it brings out in terms of the Fed is the potential for the Fed to slow down the hawkish rhetoric. But, I think credit markets are trying to feel out the Fed put as well.
But John, the Fed wants tighter financial conditions. So I guess how do you tell where the line is between where wider spreads are a good thing for the Fed or a bad thing?
It's really where trading and liquidity break down in the marketplace. I think that's what's important to pay attention to. And so if you see bid-ask spreads widen out materially, I mean, you go back to COVID, you couldn't trade treasuries. There were 5-point bid-ask spreads in the most liquid types of markets in the world. And so everything kind of breaks down when the base asset for valuation of any other risk asset breaks down. So I think really it's the underlying trading liquidity conditions. Dealers step away from the marketplace. Market participants are facing outflows. That's what an unorderly unwinding is what we're going to be paying attention to.
All right, John. So for a lot of this year, where the sell-off was concentrated wasn't so much in quality; it was in duration. It was about how far out in maturity-wise you were looking. Is it now shifting back to quality?
Yes, absolutely. In high yield, and we've been talking to investors a lot about this opportunity in high yield, really the high quality segment, the double B part of the market, which is more than 50% of the market, was selling off because for the first time, we actually had rate sensitive paper in high yield, these lower coupon, longer duration type assets. And CCC yield to call paper, that was the consensus trade coming into 2022 was to be shorter duration, to be lower down in terms of credit quality, but that has been rapidly unwinding. And the unwind is a function of two things. One, it's a function of fundamentals deteriorating in the marketplace, but two, it's really investors selling what they can and selling things that aren't down as much as the overall marketplace, but that'll quickly correct itself.
John, you mentioned that high yield trade. I think a lot of that was also simply a function of the extremely high energy prices that we were seeing as well. As we start to see this conversation of scarcity, whether it's food scarcity or simply commodity scarcity, do you think that high yield trade, the CCC, essentially the energy players, become a no-brainer trade when it comes to the credit market?
Well, we've been overweight energy, for some time here, and we still see a lot of value. And high yield's one of those asset classes that is overexposed, with energy being roughly about 13%. But actually, most of those energy producers now that are in high yield are actually double B. They used to be CCC. They've been upgraded pretty rapidly here, and most of the largest capital stacks, you could think of companies like Occidental or Apache, will most likely migrate to investment grade within the next 12 to 18 months. So for the first time in a long time, high yield energy has actually been a meaningful tailwind for the asset class. But yeah, I mean, we still feel very constructive on the underlying oil and natural gas commodities. And these companies are, really focused on return of capital, but living within CapEx, and the living within CapEx, and in fact underinvesting really is a dramatic shift from a management priority from what we saw leading up to the 2014, 2015 oil price collapse.
All right, John, so that's your view on one sector. Let's get your view on one company in particular. That would be Twitter. There is a question as to whether Elon Musk's $44 billion deal will actually go through. But if it does, there is $13 billion in debt attached to that. So this is a company that could be looking at, $1 billion in annual interest expenses almost. What is your thought? What are your thoughts around that capital structure?
Yeah, I mean, math's hard even for a rocket scientist, I think. But, you're right. Look, if we're using prevailing interest rates for single B and triple C issuers here, you are probably at roughly $1 billion of interest costs. And if you annualize their CapEx from the last quarter, obviously not giving guidance anymore, you're talking about $640 million of CapEx. So CapEx and interest costs north of $1.5 billion. This company that really hasn't gotten to that type of EBITDA level. So it's a tough capital stack. Twitter made sense when they were in a net cash position with de minimis interest cost, because it's a business that has really struggled to figure out how to monetize its customer. So, we would say that this is pretty challenging here. And what you're seeing is non-traditional lenders kind of come into the space to help facilitate this debt stack. And that speaks to Musk's creativity.
Yeah, absolutely. Creative. He also has a few rocket scientists on hand to ask, doesn't he, John? So that's useful. Thanks very much, John, for joining us. John McClain of Brandywine Global, thank you so much for your time. Coming up later today, Vanguard's chief economist and head of investment strategy, Joseph Davis. That's at 1:30 p.m. in New York, 6:30 p.m. here in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta and Kailey Leinz in New York. Tom Keene, co-anchor of Bloomberg Surveillance, also joins us this hour. And what an incredible period in the markets. And I'm really fascinated to see what your single best chart contributes to the market conversation today. Good morning, Tom.
Good morning, Anna. This is a chart that's been out there for ages. I've been using it really since the beginning of the pandemic. A definition of a broader equity index. Correction, negative 10%. Bear market is in negative 18 or negative 20 in the literature. This is the Dow. I use the Dow because it's the emotional grab for most of America. And I know SPX is more accurate. Down we go. The yellow line is correction. We've blown through that as of the close. We're halfway to bear market. You need about a 3% move, Anna, on a drawdown from negative 15 to get you to Dow bear market. We're heading there quickly.
So, Tom, who are you going to ask about the market sell-off this morning?
Well, we're going to talk to a lot of people. I mean, I think it's very, very important to line up a cross-section of people. This is really important. We're going to talk to bond people about the equity market and equity people like John Stolfus of Oppenheimer and Company about the bond market. They're linked. The other thing I'd note this morning is Swiss franc has finally moved. Swiss franc safe haven. That's an important tea leaf.
Yeah, the haven, not the dollar this morning. Thank you so much to Tom Keene, co-anchor of Bloomberg Surveillance. Looking forward to those conversations over the next 3 hours. Now, what else are we looking forward to today? I will be keeping a close eye on Kohl's earnings. Of course, this stock fell in tandem with Target yesterday, down 11% in the Wednesday session. It's off another 7% or so in pre-market before it even reports. Kriti, how much is it dealing with the same inflationary headwinds as we saw Walmart and Target dealing with? And also, what does that do to the activist investor concerns that are involved with this company in particular? Will be really interesting to see as they report into what is a very, very tough tape, with futures down about 1.5% at this point.
A very, very tough tape. Also a very, very tough eco environment as we talk about simply the jobs market. Still extremely tight. I'm watching initial jobless claims and the Philly Fed business outlook, both coming up at 8:30 a.m., Anna.
Yeah, absolutely. I mean, the jobs picture, the only good news out there, but is it, how tight is too tight? I'll be watching the G7 finance ministers. They're meeting in Bonn. Interesting to see what they say about aid to Ukraine, of course. They've had very warm words, lots of messages of support in the past, but will there be actual cold, hard cash behind those warm words to go with that today? We'll also be looking for what they have to say about FX markets. Of course, the strong dollar had been a headache for many of the other G7 until recently. Is that changing a little bit in markets? As Tom said, we see the Swiss franc and the yen. Those are the havens today. That's it for this program. Surveillance is next.